Dividends are a terrible way to build wealth. In fact, if you are in your peak earning years and actively chasing yield, you are mathematically sabotaging your net worth. It is a wildly unpopular opinion, especially among the millions of investors who treat dividend checks like sacred free money. But the math does not care about our feelings. We have been conditioned to believe that buying dividend aristocrats, never touching the principal, and living off the yield is the ultimate financial endgame. And while that sounds incredibly comforting, applying that strategy at the wrong stage of your life is one of the most expensive mistakes you can make. The truth is, dividends are objectively destructive during the wealth accumulation phase. They create a massive, invisible drag on your compounding potential. But there is a twist. Those same destructive dividends become a mathematically and psychologically superior tool the moment you shift into the wealth distribution phase, otherwise known as retirement. The financial industry wants you to pick a side, but the reality is that the goal determines the math. Before we dive into the brutal math of tax drag and sequence of returns risk, let us set the stage. The financial zeitgeist right now is split into two warring camps. You have the traditionalists who preach the gospel of yield, and the modern academic camp who will loudly tell you that dividends are entirely irrelevant. The modern camp argues that total return is the only metric that matters, and they are technically right on paper. But paper is not where we live our lives. My goal on this channel is to bridge the gap between financial theory and human reality. If you appreciate a strictly logical, numbers-based approach to optimizing your net worth, taking 2 seconds to hit the subscribe button is the best return on investment for your time today. It costs you $0 and helps me keep the financial dogma out of these videos. To understand why we are so obsessed with dividends, we have to look backward. The average American clings to the dividend myth because they are desperately trying to recreate something that no longer exists. That extinct financial creature is the corporate pension. For generations, financial security in this country was defined by a predictable, recurring check that arrived in the mail every single month, regardless of what the stock market was doing. As 401k plans slowly replaced pensions, the burden of retirement risk was entirely shifted onto the individual. Suddenly, you were responsible for managing a massive pile of money and figuring out how to not outlive it. Faced with that terrifying reality, retail investors naturally sought out high-yield stocks and closed-end funds. They are using dividends as a psychological substitute for the pension their parents had. They want the safety of a recurring check, so they do not have to watch their share count drop. The harsh reality is that the safety net of the mid-20th century is gone. The responsibility of capital preservation now rests squarely on the shoulders of the retail investor, and unfortunately, most people were never taught the mathematics of distribution. They are trying to solve a 21st century problem using a 20th century toolset. On the other side of the fence, the modern pushback against dividends is being driven by investors who came of age during the longest tech-fueled bull market in history. Having only experienced a zero interest rate phenomenon, these younger investors view dividends as an archaic drag on growth. They look at tech giants and wonder why anyone would want a 3% yield when they could just have rapid capital appreciation. Both camps have entrenched themselves so deeply that they are ignoring the temporal reality of money. They are both mathematically right, but temporally wrong. To optimize your life, you have to use the right tool at the right time. Being dogmatic about total return will leave you incredibly vulnerable to market psychology in your 60s. Conversely, being dogmatic about dividend yields in your 30s will literally cost you hundreds of thousands of dollars in compounding interest. We have to break the religious attachment to these asset classes and start treating them like the mathematical tools that they are. Let us look at the actual numbers. Most people stop here, look at a dividend chart, and assume that all growth is just good growth. But if you ignore the actual tax friction of dividends, you will lose a fortune. Let us talk about trap number 1, the accumulation tax drag. If you are in your peak earning years, receiving dividends in a taxable brokerage account is mathematical self-sabotage. Imagine owning a house, and every quarter the government forces you to sell off a handful of bricks, hands you the cash, and taxes you on it, even if you just wanted to leave the house alone to appreciate in value. That is exactly what a dividend is in a taxable accumulation account. It is a forced taxable liquidation. The government is essentially taxing your momentum. And in a high inflationary environment, that tax friction is exactly what separates the people who reach financial independence in their 40s from the people who are forced to grind away in a cubicle until they are 65. Let us look at exactly how much this invisible tax penalty costs. Let us run the baseline variables for our current tax environment. We will assume a federal dividend tax rate of 15%, plus the net investment income tax, plus a standard state tax. We can safely assume a blended 25% tax drag on your yield. Add in a 2.5% inflation drag, and the picture gets bleak. Imagine a $500,000 portfolio with a 20-year time horizon. Asset A is a pure growth asset, delivering a 10% annualized capital appreciation. Asset B is a high dividend asset, also delivering a 10% total return, but split as 5% appreciation and 5% dividend yield. On paper, both of these assets look identical. If you ask the average retail investor, they will often choose asset B because they love the idea of seeing cash hit their account every single quarter. But the math of taxation destroys that illusion immediately. The moment the cash hits your account, the government takes their cut, and your compounding engine loses its horsepower. For Asset A, your $500,000 grows tax-deferred for 20 years. You only pay taxes upon deliberate liquidation. At year 20, Asset A is worth roughly $3.36 million. Asset B has the exact same 10% underlying return, but that 5% dividend is taxed immediately at our 25% rate. That tax drag leaves you with a 3.75% after-tax yield to reinvest. Your actual compounding rate is now 8.75%, not 10. Over 20 years, Asset B grows to only $2.67 million. The brutal reality is that the forced liquidation of dividends during your accumulation phase just cost you over $687,000 in lost net worth. That $687,000 is the direct cost of tax friction and lost compounding momentum. And according to the rule of 72, that difference in growth rates means you are losing out on roughly 1.5 entire compounding cycles over a standard investing career. But it gets worse, because retail investors who realize this often try to compensate by chasing even higher yields. This brings us to trap number 2. The yield trap. This is where investors dive into closed-end funds or distressed equity, chasing double-digit yields of 10 to 15% without understanding the difference between cash flow and net worth decay. They see a massive yield, and they assume the fund is just magically generating infinite value. But the reality of high-yield investing is often much darker. If you do not know how to read the underlying financials of a fund, you are likely falling into a trap that will systematically drain your principal down to zero. High yields are rarely free money. They are almost always a massive red flag, indicating that the market has priced in a huge amount of risk, or that the fund is cannibalizing itself just to maintain the payout. If a closed-end fund pays a 12% yield, but its net asset value decays by 4% annually, the fund is literally funding your dividend by returning your own capital to you. This is known as destructive return of capital. In year 1, you invest $100,000 and get your $12,000 yield, but your net asset value drops to $96,000. By year 5, your net asset value has dropped to $81,500. A 12% yield on that lower principal is now only $9,780. Your cash flow shrinks as your principal vaporizes. You are getting poorer every single year while celebrating a high yield. This is the financial equivalent of a magic trick. The fund managers are handing you a $20 bill out of your own wallet and expecting you to applaud. And the tragedy is that most retail investors never look closely enough at their net asset value to realize that they are being robbed by their own investment vehicle. So why do we keep doing this? If the math is this definitively bad, why do millions of highly intelligent people still cling to high dividends during accumulation, or stubbornly refuse to use them in retirement? The answer lies in behavioral economics, specifically a concept coined by Richard Thaler called mental accounting. Mental accounting is the human tendency to treat money differently based on its origin. Investors view capital appreciation as the principle. It is sacred and untouchable. Conversely, they view dividends as income. It is spendable and safe. Mathematically, the Modigliani-Miller dividend irrelevance theorem proves that in a frictionless market, a dollar is a dollar. A firm paying a dividend just lowers its stock price by the exact amount of the dividend. But psychologically, selling a share of stock feels like amputation, while cashing a dividend check feels like a harvest. During the accumulation phase, dividends provide a tangible, quarterly dopamine hit. It is physical proof that the system is working. People gladly pay the invisible tax penalty in exchange for this psychological comfort. But the game theory completely flips when you enter retirement. During retirement, the hidden penalty of a pure growth portfolio is emotional fragility. You are no longer fighting tax drag. Your new enemy is sequence of returns risk. Most pure growth investors stop here and assume they can just sell 4% of their portfolio forever. But this is the exact step where they lose $50,000 or more in a single panic sell. The math flips the moment you stop working. Assume you have a $1 million portfolio and you need $40,000 a year to live. In year one of your retirement, the market crashes 20%. The pure growth investor must now sell $40,000 of stock at a massive discount. They are forced to liquidate 5% of their shares just to survive. Because they have fewer shares, they cannot fully capture the mathematical upside of the eventual market recovery. Their portfolio enters a death spiral. Human psychology kicks in and the retiree panics. They stop selling shares when they need them most. Now look at the dividend income investor, who is using targeted closed-end funds, or aristocrats, yielding 4%. When the market drops 20%, they generate the $40,000 organically. 0 shares are sold. The principal net asset value may fluctuate violently, but the share count remains entirely intact, preserving the cash flow engine. A dividend portfolio in retirement is a psychological hedge. You sacrifice peak theoretical optimization of your net worth to guarantee behavioral compliance and protect your cash flow. This is where conventional wisdom says to hold the line on growth. But I'm going to tell you to completely restructure your assets to protect your sanity. You cannot execute the survival strategy if you do not actively track your cash flow, which is exactly why I built Cash Class. You need a system that acts as a bridge between the mathematical theories we talk about on this channel and the actual execution inside of your real-life portfolio. Cash Class is the official Tom Talks Money web application. It is designed specifically for optimizers who care about privacy and precision. With Cash Class, there are absolutely no invasive bank logins required. You simply upload your standard CSV statements, and the platform categorizes and tracks your exact cash flow metrics. It forces you to look at the math without handing over your banking credentials to a third-party data broker. Plus, when you join, you get access to our free Budgeting 101 course built right into the platform to help you establish your baseline survival numbers. Click the link at the very top of the description to start your 14-day free trial on the web. It is the best way to support the channel while taking control of your own data. Now that you have a system to track your numbers, let us talk about the specific protocol required to transition your money from the accumulation phase to the distribution phase without triggering a massive tax bomb. To optimize your wealth over a lifetime, you must compartmentalize your strategy into 3 distinct phases. Phase 1 is the total return accumulator. This covers your life from age 20 all the way to reaching your coast fire number. The goal here is maximum net worth with minimal tax friction. You allocate 100% of your investment capital to broad market, growth-oriented index funds. If a stock or fund yields more than 3% during this phase, it is mathematically inefficient for a taxable account. Keep high-yield assets strictly inside tax-sheltered accounts like a Roth IRA if you simply must hold them. Let capital appreciation do the heavy lifting while you focus on increasing your primary income. But this aggressive growth stance cannot last forever. We have to prepare for the transition. Phase 2 is the 3-year glide path. 3 years out from your planned retirement date, you must transition from net worth maximization to cash flow stabilization. Do not trigger massive capital gains taxes by selling all of your pure growth stocks at once. Instead, begin routing all new incoming capital and all reinvested dividends exclusively into income-producing assets. You are using your final years of peak earning to build out your income floor without liquidating the growth engine prematurely. This glide path gives you a full 36 months to test the yield generation of your new assets before you actually pull the plug on your day job. You can verify the cash flow in real time. This perfectly sets up Phase 3, the income floor. Your singular goal here is to nullify sequence of returns risk entirely. You are no longer trying to beat the market, you are trying to survive it. Calculate your exact baseline survival number, including housing, food, and basic healthcare. Build a yield portfolio that produces exactly enough cash flow to cover this specific number. If you are using closed-end funds to hit your yield target, you must run the uni test. Only buy funds with a positive, undistributed net investment income balance and zero destructive return of capital. If a fund yields 9%, but its net asset value has trended downward over a 10-year period, reject it immediately. For discretionary expenses like travel and luxuries, use a hybrid model. Sell pure growth shares only when the market is sitting at all-time highs. This hybrid approach gives you the safety net of a pension combined with the infinite upside of a total return portfolio. It is the ultimate optimization of both mathematics and behavioral psychology. The best logical analogy for this entire life cycle is an apple orchard. Capital appreciation is growing the trunk of the tree. Dividends are picking the apples. If you pick the apples while the tree is a sapling, you stunt its growth. You are siphoning off the very energy the tree needs to build a strong foundation. But once you enter your distribution phase, the game fundamentally changes. The tree has already reached its maximum required size. Once the tree is fully grown, picking the apples is the only logical way to feed yourself without chopping down the actual wood to burn for warmth. Dividends in retirement act as the suspension system on a vehicle. They do not increase the top speed, but they absorb the violent potholes of a bear market, preventing you from panicking and abandoning the vehicle. The math determines the top speed, but human psychology determines if you actually finish the race. Optimize for growth when you are young, and optimize for psychology when you are old. If you have made it this far, I invite you to click the Join button below the video to become one of the optimizers. Channel members get priority replies to all comments, meaning I will actually see and respond to your specific math questions. And you get custom sketch badges next to your name. It is a great way to support the deep dive research that goes into these presentations. Run your own numbers. Question the dogma. Let me know in the comments if you are in the accumulation or distribution phase, and I will see you in the next one.